Mike Langford. Welcome to another episode of the Modern Financial Advisor Podcast. On this episode of the show, Justin Whitehead, CEO of Pebble Finance, is with me for a conversation about one of the most immediately applicable use cases of AI for financial advisors that I have seen so far. Now, it's hard to escape the chatter about AI in our space, and frankly, some firms are doing a little AI washing, if you will, basically slapping AI on their tool and saying, look, AI, awesome stuff. Pebble, however, is bringing something that you and your clients are absolutely going to love, some much needed understanding of what is actually happening in their portfolios. Now, before we get to the conversation with Justin, please do make sure you subscribe to the podcast on Apple Podcasts, Spotify, Google Play, Amazon, the YouTubes, or wherever you like to get your podcast jam on. And if you have a question or a suggestion for a topic or a guest, hit me up. I'm basically at Mike Langford everywhere on the internet, or you can shoot us an email, podcast@finsermarketing.com. Okay, let's jump into the conversation with Justin Whitehead. Well, Justin Whitehead, welcome to the Modern Financial Advisor Podcast. So wonderful to see you this morning.
Nice to see you as well.
That's great. It's good to be seen. It's also good to be seeing you using that awesome new microphone. We had a funny conversation. You're getting used to it. You're doing great already. You're fantastic, like a pro. Like you've been behind the microphone for a long time in your career. It does take some getting used to, right? If you're new to the medium, it's really funny. I talk about this not infrequently. How new the concept of just being on video and talking to somebody across the internet is. It's like, 10 years ago, well, you really weren't doing this, right? Some tech startups were still already using Zoom or whatever, Skype back in the day.
It went through two hills. There was a time where video conferencing didn't exist. Yeah. And then it was like really good, but super expensive, like Cisco, whatever, whatnot. And then Zoom and Google and all those guys went and like commoditized the big beasts. And there was like this trough of like, man, everything is kind of crappy again, but we're back at a sweet spot, I think.
Well, it's kind of funny when FaceTime first came out, right? And on your, first of all, front-facing cameras on your phone changed everything. But once FaceTime came out, you're like, I like this, because we had moved here to Austin, Texas. My family's still up in Massachusetts, and I'm like, this is great. I can interact with my parents, and fire up FaceTime, talk to the kids with the grandparents and so forth. But it was funny, like it was a slower adoption curve than I thought it would be. That people were like be willing to face on their phone. Like if you're of a certain age, you remember growing up and watching things like Get Smart and the reruns. I'm not old enough to remember them when that was live, but it was on the reruns. Like these shows were like
Nick at Night on Nickelodeon.
Yeah,
Get Smart. Like, I was there with you.
Yeah, and all those types of shows, like this was science fiction stuff. And then when people who grew up in the era where the whole notion of video conferencing was like, this is the future, and you'd think they'd be excited about it, they're like, meh. What? This is great. Anyway, all right. Well, people didn't tune into this episode to hear us wax, like nostalgic about sci-fi becoming a reality in our lives. And they want to hear about Pebble and all the awesome stuff that you're doing and how this could impact their business. I thought a fun way to kick things off would be with something you said almost in passing during our prep call. You mentioned that the pandemic sparked a surge in retail investing, which I don't think you're wrong on that. And that people all around the world were, stuck at home, bored, thinking about their future, nerding out on stuff. And so you give folks access to the internet and free trading platforms like Robinhood and, easy stuff like crypto. Next thing you know, everybody's an investor and everybody's kind of an expert. But in the professional investment world, I'm sure you've discovered this. Well, those people are sort of called dumb money, right? Retail investors, especially new ones, are often called dumb money. And in fact, if you're on Wall Street or whatever, when they see an inflow of dumb money, a lot of times the professional investors give that as an indication that's time to sell, right? Like, okay, it's time to get out. Here come the rubes, right? But and it's not that these people are smart and so forth. It's just like you're inexperienced, right? You haven't gone through things. You haven't studied the markets as much as the professionals who do this for a living and get paid millions. Well, you mentioned that was kind of an experience for you. Like you had a little bit of a dose of that yourself, right? And it was one of the things that really led you to launching Pebble. So I wonder if you wouldn't mind sharing your story, because it's really interesting. I actually watched a video of you doing this story in front of a group, group of people at a conference and so forth. And that was one of the things that got me excited about having you on the show. So let's launch into it. Like, talk to us about this impetus of your investing in China experience.
Yeah. Going back to the pandemic. So we started the company, it's been about 5 years ago. So straight middle of the pandemic there. Yep. Observation was you had a ton of retail investors jumping into the market. I think, yes, step back historically, I think we categorize this all as dumb money, but I think that's actually like the definition has changed quite a bit. At some point maybe we could get into the demographics of this money here. But one of the things that you did see is that people were learning and interacting with markets and learning how to invest in completely different ways than, say, like when our parents were getting into the market and things like that. And that's what we found, super fascinating and spirited a lot of ideas in terms of like, hey, this type of retail investor is different. They are talking about money in different ways. Money means things to them in different ways. We've got people sharing horizontally, learning how to invest from, hey, sure, like what they see on like social media, but they're also learning from like coworkers. It's not, do what your parents do and, inherit, if your parents are using a financial advisor, inherit your parents' financial advisor. There's this different chord that's coming out. And I thought that was fascinating. But, going back to like myself, so you mentioned the China story. So while I am probably more financially literate than your average retail investor, I'm also human. I can also call myself, proudly dumb money as well. So it was a couple years ago, I read a book, and that's how all bad, disastrous stories start, is when you read a book and it sparks an idea and you're like, oh, I'm going to go act on it. So the book was called 2034. Some magazine had like a preprint of the first, few chapters of it. And it was this war between China and the US set in 2034. And TLDR, like the US was just getting crushed. Like all of a sudden, technological advancements from our adversaries that we didn't see coming were sinking our ships and crashing our planes and all that. And I kind of looked at myself, looked at myself like financially. It's just like, man, I well aware, like I'm completely US concentrated. I had no investments in China. So I called my guy. I'm not going to say the name. I'm not going to say the firm. That's not professional. But I called my guy and I'm like, hey, I should probably be investing in China. And I got the spiel that you would imagine. Like, Justin, this is a great idea. Diversification is great. Yeah, you're very concentrated in the US. I highly recommend putting some boots on the ground. Let me go put a couple options in front of you. And week later, days later, whatever it was, get this nice, fancy PDF of all these different funds and strategies and all that type of stuff. And I'm like, all right, I'll pick option B. And that was that. And look, hey, great, I'm in China. Then, and I don't know if it was like within a month or within days, it feels like days in hindsight, but Xi Jinping starts cracking down hard on Chinese tech companies. So, Alibaba and Tencent, these were, they were listed in exchanges all over the place. Xi Jinping was just like, no, that's all coming home. And that sent shockwaves through the Chinese markets. It didn't matter if you were an actively managed fund or tracking an index or anything like that. Like, you lost 30-40% in a matter of moments. And this is like, worst timing possible. Yeah. It's just like, great, I just got in here and within 2 weeks, I'm already down 30 or 40%. Yeah. I didn't get a call, no, like, hey, this might have like, I know this just happened in the world and might have affected you and, horrible timing and all right, but stay the course and all that. No call, no nothing. But this firm has a very prominent CEO, thought leader type CEO. And I forget if it was something that I read or something that I saw like on a CNBC. But this thought leader talked like, hey, we've been, was talking about China and thought leadership on China. And was like, hey, we've been warning clients about, the problems, the potential risks in China for months now. So like, it wasn't that surprising to him. I'm just like, wait, that never came up in the conversation. And I, being a financial nerd, went and I have access to like all the research from this firm and all that. And I start like digging back and searching for things on China. And lo and behold, I was finding tons of research from this own firm about like, the potential crackdowns and all, escalating activity and all that type of stuff. Never came up in the conversation. So in a sense, and yeah, we can laugh about this now and cheeky and all that type of stuff, but like that's a failure in my, like, how that does not elicit trust, and I do not, to this day, I do not have this person sitting there, I'm not giving them an asset management fee to run my funds. It's just like, my money's still there, but like,
so many things went wrong there. So number one, I mean, and this highlights the problem, and advisors and wealth management executives who are watching, it's like, well, there are some advisors who are technically stockbrokers. That's, they may call themselves financial advisors, but they are registered reps with a Series 7, and they are there to sell you whatever you want and tell you to sell things to get out so you can free up cash to invest in other stuff, right? That is their job, right? So you said, hey, I want to buy a Ferrari, and they're like, wonderful, we've got Ferraris to sell, whatever, maybe it wasn't a Ferrari, right? but the point is, you told them what you wanted to buy, and they're like, sure, happy to help you. This is fantastic.
And I totally, and I get that.
Yeah.
And I don't, it's no fault. I'm still working with him to this day and all that. But is that what, when you ask an average investor, what do you think a financial advisor does for you and doesn't do for you? Like, what is their definition?
Well, what was the advice,
and what's their understanding of this versus how is it being looked at the others? And that's where, when we look at this new demographic of investor that is entering the market and all that, I think there's a big cognitive disconnect that we just haven't quite touched.
And I think Pebble really leans into this, and we're going to be diving deep into how your solution works here. But one of the challenges, goes for everybody, and it's not just investing, right? Is when you have a selection bias in the information you chose to seek out, right? So you see a lot of it, healthcare stuff now floating around the internet. Like, well, I did my own research. Like, well, did you really though? Right? Because there are people who have spent billions of dollars and collectively millions of years researching diseases and vaccinations and all these other types of things. Did you really do your research, or did you find a couple of blog posts that say that's BS, right? Like, that's a selection bias scenario, right? And did you ask yourself, well, what if this is wrong, right? All these types of things. And when you hire a professional, right, sometimes that professional's job, or actually I would say in this case with your finances, oftentimes their most important job is to protect you from your own decision making, right? Like, listen, because we make decisions emotionally. Hey, I picked a stock. This stock's awesome. I'm a flipping genius, right? And when the stock starts going down, you're like, that's okay. Things go up and down. But when it starts cratering, it's going down, and you're like, we're about to crash here. You're like, I don't know what to do. And you just panic, and you're like, so there's a study, and actually it's this kind of the second time I've mentioned this recently. There's a Dalbar study. A company called Dalbar does research, and they research the performance of professional money management and the average investor. The average investor who DIYs it underperforms professional money managers like dramatically, right? The average investor who manages their own money makes like 2% a year or something like that on average return. And then the average with a financial advisor, you're making like 7 to 9%, on average. Like, it's a monstrous gap. And it's just because the average investor will get excited about something, buy into it while it's exciting for everybody. So buy high when things are going, but then when things are going terrible, they'll panic and pull out. So sell low. The opposite, buying high and selling low. They'll do that type of stuff. So it's really crazy. You are not alone in that type of stuff. But what you discovered is like you want the firm to protect you, right? You want the firm to offer some level of next level guidance.
Yep. Yeah. There's a book I read, gosh, had to be over a decade ago. I think it was around the financial crisis. It was called Mean Markets and Lizard Brains. For whatever reason, you mentioned the Dunbar study, and for whatever reason, that just, I don't know why I thought of that book initially, but yeah, I mean, we are all, genetically predisposed to like being horrible investors. That is absolute truth. What is fascinating is, are you a big Reddit user? Do you consume Reddit?
A little bit, not a lot. I mean, I will find myself there if I've starting to research something, but no, I don't have any particular Reddits that I'm like binge reading.
So when I started the company, I got into Reddit hard, which was and it is a fascinating way to go ahead and look at, observe, study human behavior in a self-organizing way. And you see this in finance as well. Like you've got the YOLO investors on Wall Street bets doing exactly what we're gonna buy GameStop and AMC at the peak and do all these crazy over leveraged strategies and all that type of stuff. But on the flip side, you've also got things like the Boglehead community and all that. There's like half a million members there, which are just like all chanting the like completely passive 3-fund. We got modern financial advisors who are putting people into model portfolios, and it's just like this community has gone around, and it's like a tribe that you see, just like kind of like 3-fund portfolio, VTI and chill, or whatever type of thing is. And what's interesting is like it's a counteract to a lot of this lizard brained type behavior. Like, something, when Trump tariffs came out and were tanking the market and people are panicking, you see all the chatter on Bogleheads, and people are just like, don't be emotional, and trust the model and all that type of stuff. Is wild to see.
It is pretty cool.
These groups forming. Highly recommend spending more time on there.
Well, what's really interesting about that, and I'm glad you bring up the Reddit and just online information, right? So going back to the original, teeing things up, talking about dumb money. Dumb money's not as dumb as it used to be, because there's way more information. The democratization and access to information cannot be undersold, right? So it used to be the whole reason why we have financial advisors and originally stockbrokers and so forth is financial instruments are very complex for the average person to understand. Most people didn't study this stuff, right? So you needed a trained salesperson, and we decided they needed to be licensed as well, right? They needed to have some base level of skill, provable skill, to be able to go talk to an investor and say, here's what this investment is, here's what it does, here's how it is relevant to you and your financial situation. So at a stockbroker, it's got to be at least suitable, right? I can't be going, selling out of the money call options to an 85-year-old on Social Security, not suitable for her. Now, if you're a registered investment advisor, right, it's got to be a fiduciary standard, a higher standard.
Higher standard.
Right?
Yep.
And again, our audience is well aware of this, but like there's a reason why those different licensing and rules exist. And there's a reason why we have this industry. This stuff is somewhat complex, but as the information becomes more democratized, it's great for those who are diligent in doing their research and reading and understanding. Both of those strategies, by the way, can work, right? The Bogle type strategy can work and be effective for you. They also, hey, listen, there's going to be lots of times when there's a massive opportunity for you to put some assets at play in a super risky speculative bet that the momentum just says, man, you're going to make a crap ton of money in Bitcoin or whatever this type of stuff is, because look, I mean, there's so much money coming into it. It will push it up. Eventually, will it crash? Probably. Right? Probably there will be some sort of reckoning at a certain date and time. We don't know when that is, right? So really fascinating stuff.
I will say there's a counter push to the access to information. So there was a lot of good, high quality access to information early on.
Yeah.
But then it got too much.
Yeah,
and you start seeing conflicting opinions, and everyone's, it's all these websites out there trying to attract eyeballs and and thus ad dollars and all that type of stuff. And I think the access is out there, but now there's a little bit more onus on the individual investor to go ahead and actually do a little more due diligence before they just blindly, take what they see firsthand, or what pops at the top of a Google search result.
You're going to have to, you need filters, right? You need trust filters, right? Because if anybody who spends any time on social media knows there's people who are just spewing stuff, you're like, that is not true at all. What are you talking about, right? And so if you let it all in, you've got to find some way of filtering it out. And that's, again, working with a financial professional. And if you are the financial professional, our audience members, you've got to find a way of connecting with your clients or your prospects and say, hey, look, we're going to work with trusted information. And you kind of like go through that. It's interesting. I just had a recent episode with Felipe Taves of Taves Asset Management, and talking about the behavioral portfolio. Really fascinating conversation. And Felipe made the point of like, many financial advisors are not communicating the full breadth of like how bad things can get. Like, in other words, they're not communicating worst case scenarios to the clients. It's an overly rosy picture. And of course, we want our clients to feel confident that working with us is going to help us, achieve the financial future they want. But you're doing them a disservice by not telling them like how bad it could get, like what could happen in China, for example, right? Like, it's not that you shouldn't invest in China. It's like, here's some things. This is, there is, government risk over there. There's this, foreign currency risk. Let's go through these things and how bad could it possibly get? All right, if that's the worst case scenario, are you comfortable with it? We don't know how likely that is. Okay, what happens if that worst case scenario comes true? What do we do then?
And honestly, like going back to my personal China scenario, had I, been told like, hey, like this is what our firm is thinking about it, and all that type of stuff, I probably still would have invested in China. I'd be way less pissed on the opposite end of what happened, because like, I can only blame myself. I went in full knowing and that sort of thing. And I feel comfortable like, all right, that's on me a little bit. That's what Justin gets when he reads a book.
We all get this. Like, there are times when you get advice. Somebody gives you, hey, I've got to tell you to do it like this. And you're like, okay, well, that's great. Thank you for your advice and guidance. Anybody who has kids, by the way, knows exactly what we're talking about. You tell your 20-year-old, I've got a 20-year-old and a 16-year-old. You give them, hey, I've been prone recently to it. Instead of just telling them what to do, it's like, hey, are you open to a little bit of advice? I've done this a little bit. Let me just tell you that maybe consider this. And sometimes they listen, sometimes they don't. All right.
I can't control how it's going to be listened or interpreted to, but you do your best effort to put it out there put that information out there to the universe. I won't
give you the told you so, but you certainly can't come to me and blame me that I didn't give you some information. Anyways, let's shift gears into Pebble specifically and the things you're doing, because I was just talking about Felipe Taves and that episode and so forth, and one of the things that popped into my mind, some connective tissue there between that conversation and this one, is there's an ignorance gap, right? Like, sometimes the client doesn't know what they don't know, right? It's not dumb money. There's some ignorance about the way things can happen or what's going on in their portfolio. You mentioned it's really easy to know what's happening in your portfolio when you have those 3 ETFs, the bogleheads, as you call them. You got to maybe be under the hood of what's happening in the markets underneath. But for the most part, you can kind of rest assured that you've got a mix of a whole bunch of stuff. Here we go. When we get into individual securities or individual funds and so forth, they can get a lot more complex, right?
Very quickly.
Or if you're looking at certain sectors, or countries, as you're talking about, I want some country exposure. How does Pebble collect and present information to the advisor so that he or she can kind of better inform their clients and what's happening in their portfolios and hopefully close this ignorance gap?
So I'll tell you, I'll frame it in terms of like what my background is. So way back when I was a wee little lad, I built an application, a product, or as part of a team that built a product at a company called FactSet. called portfolio analytics. So if you fast forward to today, if you are an institutional asset manager anywhere in the world, there is a high likelihood chance that you are leveraging some of my technology as part of your flow to understand mathematically what's going on inside the portfolio. And this is fantastic. Like, very, very valuable, interesting analysis that can convey a lot of meaning and understanding as to what's going on to a portfolio or inside a portfolio to someone who's got a CFA, so to speak. The problem is that type of analysis will very quickly fall on deaf ears if you don't have a CFA. So take your average retail investor who might not even know what an ETF is in the first place. Like that, was some shocking discovery in the early days of Pebble. Like you really found out how low of a bar you needed to get to. What Pebble does is we take a look at, we mathematically analyze portfolios, but then we will read what's going on in the news. We'll do the math. We'll figure out the numbers. We'll read what's going on in the news. If you are, let's say, an asset management firm or a wealth management firm, and you've got your own proprietary research, we're going to go read your research based on the events that we are identifying that are moving this portfolio, and we can actually, distill for that advisor or that advisor's client directly, if you wanted to, hey, this is what's going on underneath the hood, not with, just numbers and charts, but like, here's the real world. Here's the events. Trump just did, X move with tariffs, and it had this, ripple effect in the market. And this is what it means for you, the individual. And what's fascinating and enabling for all the advisors, and this is where it kind of gets back to that cognitive disconnect between, what is a client to an advisor versus what is that advisor to a client. As a client, my guy is my one and only guy. It's a one-to-one relationship as far as I'm concerned.
Right.
But I am one of 30, one of 100 of this guy's, relationships and all that. The reality is the advisor can't have that level of detail and nuance understanding and that type of conversation with each and every client. So what we're trying to do here with technology is how do we enable this advisor to, right there, heat of the moment or in prep for a client call or anything like that, start speaking the language of what's going on in the portfolio in real world terms, connect it to things that their clients might have, read in the paper, read on, CNN or whatever, connect it to things that, and connect and read the research and really fully inform that in-house opinion on what these events are, and connect all those dots so that advisor can give that one-on-one relationship to each and every one of their clients, but do that at a click of the button type of deal. And going to speaking the upside, you talk about the upside and you arm that advisor with what's going not so well as well. Now, I can't control whether or not an advisor has that half of the conversation. That's up to them. But, we will go ahead and be unbiased in terms of how we go ahead and paint the picture for that advisor.
There's so many things I love about what you've built at Pebble. One is, to your point, being able to communicate to the client using language that they'll understand, right? So we are the only industry that actually speaks Greek. Alpha, beta, yada yada, it's kind of ridiculous. And there's been a lot of effort to change that, right? To your point, most clients don't know the difference between a stock, bond, mutual fund, ETF. Right. They don't understand these things. If you just poll the average investors who actually have a financial advisor, what's the difference between an ETF and a mutual fund? They're I don't know, right? And they might butcher it, but what is a stock? What does it mean? Right? They might not truly understand. It's the stock market, of course. That's it's just, so being able to communicate in real world terms is awesome. And then the other thing that's, to me, that jumps out as a massive value proposition is advisors really do struggle with content to present to their client, to have that conversation. So beyond the performance report, think about, again, most of these advisors working their way up from the broker origin story to a financial advisor. Historically, it was like, I told you to buy this. I told you to sell this. Last quarter, you had this much money. This quarter, you have this much money. Here's what performance looks like. You're doing great. You told me your goals are this, this, and this as we evolve into financial advisory stuff. Okay, great. You want to retire at this age. You want to live on this type of income. You want to send your kids to this school. You want to live this legacy. You know what? We've run some Monte Carlo on how much money you have and how it's invested. You are still on track. Awesome. Looking good. Here's performance. What else do you want to talk about? There's a need for richness there. And I love that Pebble's bringing that out.
Yeah, it's a lot of what you see is very templated type deal, as you mentioned. And this is also gets into, when we think about wealth, when we think about like, hey, 10 years from now, when all the folks here that have been, are getting their first experiences with retail investing through, Robinhood and all that type of stuff. And, we're trying to collectively be like, hey, there's this value proposition of, hiring a financial advisor. And yes, it's this AUM fee and all that. Are they going to sit there and expect it like, yeah, all right, great. Once a quarter, I get this template and I'm paying 1% for, numbers that change. Like, I think the expectation is a little bit higher than that. So in that regard, and this is something that we don't actually have like actively out there, but one of the things that we're exploring is dynamically creating a newsletter. Give a regular engagement that can be, so again, step back, you're an advisor, you have 100 clients. Each of these 100 clients, sometimes they might all be in, similar or complementary model portfolios, or maybe you've got, discretionary and everyone is actually a unique snowflake, but you can tailor, automatically, content that is relative to, and, actionable to that, not actionable, but relevant to that individual client, but also have the machine interview, like looking broad scale at all the portfolios, ask the advisor, hey, like time to sprinkle in some of your own voice. Like, 70% of your clients had a negative reaction to blah, blah, blah in China. What are your thoughts on that?
Yeah.
And weave in something that is unique to that advisor. Because at the end of the day, like they're the face of that client relationship. And you want, you want to be hearing his or her words and what his or her thoughts are, because that's what that's part of what you're paying for and all that. Getting all that type of stuff through, enterprise level compliance is its own like interesting task. And that's where the technology to go ahead and do this is there. Whether or not the institutions that could adopt that are ready to kind of like take that leap and allow that to happen, full scale, is a different question. Different firms are at different parts of the adoption spectrum there.
Well, that's a great segue with you're mentioning of compliance, because one of the things I love about Pebble, and frankly, like most new solutions being brought into the advisor desktop space, Pebble's leveraging the power of AI. So, people are like, okay, another AI solution. You might get some eye rolls. Okay, yeah, we've heard it. Everybody's got AI. A few years ago, everybody's got blockchain. Now it's, everybody's got AI. But one thing that really jumps out to me is that this is one of the first AI tools that I've seen that isn't likely going to have compliance issues, or very minor ones, frankly, because you're never touching personal identifiable information. You're not actually going in and even seeing the client's names or anything like that. You're going out and pulling the information you're presenting is being pulled from publicly accessible information, right? It's you're about the securities and so forth. Tell me a little bit about that. Like, how does mechanically Pebble work, and then the information that it's now pulling and presenting to the advisor, who then in turn presents it to the client?
Yeah. So PII specifically is one leg of of compliance. There's lots of other legs as well, and maybe we'll get into that as well. but from a PI, focusing just on the PII perspective, yeah, Pebble doesn't actually know anything about the client. At the end of the day, we don't even know. Not only do we not know anything about the client, but we don't even know the amount of the assets.
Yeah.
This could be a $10,000 portfolio. This could be a $10 million portfolio. It could be a real portfolio. It could be a model portfolio. We don't know. All we know is like there's a basket of assets that have this sort of weight, and that is the minimum amount for us to go ahead and get started. Even at a more rudimentary level, we can take a look at an individual mutual fund or an individual ETF and actually generate news commentary for an ETF or a mutual fund based on what is the thesis of that fund and what is it holding and all that type of stuff. And we are reading content that we have secured data rights for. So everything that is being used is a commercial source that we're allowed to use in this use case as well. But yeah, we don't need to know anything about the end users at all, and that certainly is one aspect that has helped the adoption curve and move things faster through legal risk and compliance. The other aspects that people may or may not know about us, Pebble actually started up a SEC federally covered RIA back as part of our origin story, because we were running our technologies on real end investors, and to do that, we had to go get ourselves to be regulated. Now we did that by design because we think there will be regulation that guardrails AI and whatnot, and we wanted to be a front row seat and participate in that process and not be this like company that's going to break all the rules now and we'll figure it out later, as you've seen in the crypto and all that type of stuff world. But yeah, a lot of, from like the compliance standpoint, the questions are going to be about data governance. The questions are going to be about PII. The questions are going to come about accuracy. We generate right now 10 to 15,000 explanations a day. And we have human in the loop process and machines trained on humans to go ahead and review and calculate factual accuracy on everything. This is not like, let's just go throw a bunch of stuff into ChatGPT and see what we get out, because guess what? You're going to run into a lot of problems really, really quickly if you do that. So we've taken a bit more of a mature and industry-leading approach on that front as well. So it's interesting.
It's smart. It's smart that you mentioned that. It's like, listen, you're not just rolling out to ChatGPT. Like, you're building very specific things that are getting very specific data sources that are pre-vetted, right? Yep. That have already gone through a compliance process of their own, right? So that when you take that information, capture that information, and present it to the advisor, who then will present it to the client, it's number one, known to be accurate, known to be relevant, right? And so forth. It's a little bit of like, the old term in computers, GIGO, right? Garbage in, garbage out when it comes to coding. The same is true when it comes to AI and this type of, information that we're going to just process about the world, in this case, our investment world.
Yep.
If somebody loads up a language model with crap, you're going to get crap out. It just be polished crap. It'll just look, right? So it's got to be, look at how good this is. Hey, it looks and sounds great. It's actually based on nonsense, right? Like, so,
conversationalcrap.com. That's got to be an available domain name.
Get that,
come on.
Right? But I think people tend to forget that, right? It's like, hey, listen, like, consider who is, we were going back to the whole like conversations on Reddit and so forth. It's like, hey, can you have a little bit of a time out and consider who's the person who's writing here? What do you know about them, their credentials, their history, their experience, right?
Yep.
It might not be the best person to be taking financial or medical advice from, just so you know. Anyway, let's shift gears into something that's particularly exciting to me, because I've been in this space for a long time. I've been in your shoes where, I'm on a tech team who's going out and talking to large financial firms and saying, this technology can really help you as a firm and also your advisors are going to get a lot of value out of this. One of the challenges you run into oftentimes, and I'd love to hear like what you're doing to improve this, is adoption, right? So sometimes you go to a large firm and large firms are like, this is awesome. We're going to do a pilot program. We're going to give this to our 50 best advisors, top producers, and let them cook on it for 6 months. And it's like, yeah, but those guys are already like super awesome and then just probably not going to actually use it themselves. You're not going to get the best feedback. What we really need is like a, whatever population that looks like this or what have you. But the thing is, like, this is a great solution. This, and like a lot of other solutions, the challenge isn't whether the product is good, whether it's delivering value for advisors. Some of the challenges is like getting adoption, just getting people to use it. What are some of the things that you're either have already learned along the way in navigating this that you're willing to share, or things that you're doing to make it easier for firms to adopt it? It's like roll this out to the clients, their advisors with ease without it being like a slog.
So my background is actually in tech. I'm an engineer. I'm still a hands-on engineer, much to the chagrin of the entire team here.
Get out, Justin! Stop.
Yeah, who would have thought? But and if they hear this, they're all laughing hysterically right now. But one of the things that influences a lot of the approach, and one of the things that we did early on, is a very strong belief in show don't tell. I don't like slide decks with pictures of things, of the art of the possible and all that type of stuff. Yeah. No, I'm going to go make things possible and, allow people to have, in the lightest weight touch, manner, hey, here, you can start interacting with this in the real. I'm proud of this. I think this is really cool. And everyone I tell this is pretty cool. So one of the things that we often do is, if you are a brokerage, or let's say you are a wealth management platform, because like different wealth firms have different internal platforms, or even on the institutional asset side, almost everybody has their product in a web browser. So I'll get some sort of trial or login. I've got so many brokerage accounts, it's not even funny type of deal. And then what we do is we hack Pebble into a client's own product via a Chrome extension. So I'm on the Chrome browser right now talking to you. You can kind of think like, oh, we've got like ad blockers that remove things and all that type of stuff. We have a Chrome extension that will inject Pebble the other way. So we'll take a portfolio. So advisor could be, on whatever they're using for their dashboard or whatever. Yeah, click through the portfolios. This little Pebble button will appear on your own website. And when you click it, I'm going to read what that portfolio was, hurl it over the wire to us, explain it, inject it back, and show people right then and there. So we demonstrate by like, hey, let's have fun, seeing what Pebble could look like in your platform and allow people to interact with it. And that actually has been fairly, a fairly successful way to get the stakeholders at a business, understanding, like being able to see like real technology inside their platform, what it could look like, go ahead and try to poke it and see where the rough edges are and all that. It's all using, real tech underneath the hood, de-risks things and helps accelerate stuff quite a bit. The other aspect that we do, and I kind of mentioned this a little bit earlier, is because we do, it's what we're doing behind the scenes is mostly math, right? Mm-hmm. It's portfolio math, it's quantitative math. Yeah. And then, hey, how do you get this to, be understandable by an advisor or a client or an institutional asset manager? Like that's where an LLM is coming into play. But because of this, we very quickly and early on, as we're talking to prospects, we try to get a gauge of where people are on their AI adoption curve. So, every company starts off with, C-level execs and product people super eager to do anything AI. And I hate AI as a buzzword because it just gets overused and all that type of stuff. But they haven't had the mature conversation yet to talk about what are the compliance, aspects of this? What's FINRA going to think? What's the SEC, going to think? What are the risk teams how are they going to look at that? So we try to get those teams involved at the design side in the beginning. Very early on, legal risk and compliance teams at any of our clients, they're all scared of AI because they don't know how to judge it. They don't know how to assess the risk of it or anything like that. So the easiest thing to do is just say, no, we're not doing any of it, type of deal. And this is where we end up bringing a lot of value to the conversations early, because we're talking with we're not leaking any sort of confidential information, but I get, I can write down on a piece of paper the types of questions that I get asked that are generally applicable to absolutely, everyone. And I can tell you what Pebble's answers are to them. But a lot of the time, like legal risk and compliance, they just kind of want to know, what else are other people asking that we should be asking and evaluating? So bringing that on early in the process is also fairly valuable. So show, don't tell, involve. If you want to do anything in this realm, get LRC involved at the beginning of the process, not as an afterthought. And then you mentioned handing this out to advisors. Doing that at large enterprises, I think, ends up being counterproductive, because an advisor could be like, hey, this is the coolest thing in the world and all that. They are operating at a much faster speed cadence than maybe what the technology teams at the enterprise level and all that are doing. So if you go ahead and really sell the individual, you might end up causing some internal trouble there, because
no, where I was going with that is oftentimes what happens is, the vetting processes happen through, executive, tech, compliance team. And then oftentimes they'll be like, well, let's roll this out to a test population, right? A pilot program. So we'll let 50 advisors use this, or 100 advisors use this, depending on the scale of the firm. And oftentimes what I've discovered is they sometimes choose the wrong advisors, right? To give it to. They're giving it to the top producers, the people who already have really big businesses, right? They're working with super high net worth clients and so forth. And so they're probably already doing a lot of white glove stuff. But because they're the top producer, they get to eat first, right? Like, hey, whatever comes in here, I get this technology first. I want to be the one who say it. But they're not really going to be using it in a way that meaningfully affects their business. Whereas when I think about it, the advisor population, I can't remember if you and I had this conversation or not, but according to FINRA, 85% of new financial advisors wash out by the end of year 4. They don't make it to year 5, right? So this, we hire a lot of people, most of them don't make it. Mm-hmm. But when you go to some of these top producer conferences and you talk to them, my favorite question is to ask, hey, how many years were you in this business before you felt successful? Because, you've been, you've obviously done a great job here. It's almost always year 5. That was 5 years before I really felt like I was going to make it, because it's cumulative. It adds over time. So I always think about solutions like yours with Pebble, like how can Pebble help accelerate the launch pad, or getting off the launch pad, right? Because if I know that most advisors aren't going to make it past year 4, like, can I make it so that it's year 3 that they're starting to see some success and that they stick as a client, right? Because we also know there's a great need for financial advisors in our community. One of the things you're doing that's most applaudable is you're democratizing the ability to give high quality guidance and advice and information to clients, where this is always available to the high net worth and the ultra high net worth client.
Give that family office style service to a high net worth. Like it's not something that was scalable.
That's right. Well, that's the reason why we had model portfolios, right? It was like, hey, listen, man, if you want advice and you only have $1 million, $1 million is a lot of money, but that's $10,000 of revenue at 1%. So which again is awesome, but I need a lot of those for me as an individual to make a living. And then if I'm going to run a firm, I need a lot of those to make a living, right? So which is to your point, like so being
able to give higher level of service and actually be able to scale that to to more people. And then the other thing, I think, and granted, technology is new. It'll take a while to go ahead and see this. Client retention. I don't, and you probably could cite numbers better than I can say. I remember reading some report or whatever where it's just like average duration of a client relationship. Like if you made it to 2 years, you were fine. Like usually that was a pretty sticky relationship from there on out. But like there's a lot of churn that happens within those first 2 years. If giving that higher level of service and hey, like I can actually do something at scale that gives me monthly touch points with a client or think of like those newsletters as another touch point, ways to demonstrate value more frequently and at scale. I think that'll ultimately end up affecting those churn numbers. Like people feel like they are getting and they can see tangibly, hey, I'm getting more value uniquely out of this relationship than I would be without it. So it'll take obviously at least 2 years for that to plan out to see how these numbers change, which is always the struggle. But kind of fascinating because I do find advisors spend a ridiculous amount of time and energy just trying to drum up new business. And hey, if you didn't have to solve for churn,
well, it's true. It's like you think about the things you're doing. You want to get new clients, right? New business from new clients. You want to increase share of wallet, so new business from existing clients, right? Expand that relationship, and then you want to retain clients, right? You don't want to have a leaky bucket. And to your point, like even the larger firms. I used to work at Fidelity Investments, and I might be butchering the stat, but it was under 10 years. It was somewhere north of 7 years was the average client duration, right? So that the clients would just, and people do move, right? They get married, they consolidate, move from Fidelity to Schwab. And that's big, that's Fidelity. That's not at an individual advisor. So, once you develop a relationship with an individual advisor, but, I've said this a bunch of times on the podcast, and I think it's worth hammering home every time is organic growth in this industry is microscopically small. It's like less than 3% as growth for organic growth. Most advisors are plateaued. 40% of advisors have a net negative growth. Like they're actually getting smaller every year. And that's kind of demographics at play there. The average age of your clients is about the average age of the advisor, give or take. Yeah. You can see some consumption and so forth. So we have a huge need to grow here. Better information, giving better service, and better guidance is always going to help. Let's close it out with, you talked a little bit about the future there. So maybe the newsletter stuff, but if you got a crystal ball of what you might see in the future. What I love about you told the story about like how the name Pebble came to be. And I think that kind of gives you some guidance of like where you're thinking of like how, the scale of the services you can do is like, where did the name Pebble come from? And then maybe you got to offer us a crystal ball of what you see for the future.
All right. So we'll step back to the origin of the name and then we'll go.
I love it, by the way.
All right. So again, company started by a bunch of technology nerds. So great at technology, horrible at marketing. So I'm just going to lay the table, like that for a second. So the first technology and the first insight that we had experienced from retail investors was kind of what I mentioned again a little bit earlier. Like a lot of people didn't even know, not only the difference between an ETF and a mutual fund, but they just thought it was like another stock, type of deal. And they didn't realize like, oh no, this is actually an amalgamation of stocks. But one of the earliest technologies that we built is a technology that we have today that is leveraged in the retail brokerage space called Construct. And basically what we found is people didn't know what funds or assets to buy, but they had ideas of things that they wanted to invest in. So here up in Massachusetts, you see, lots of like EVs driving all around the place. They're like, oh, I want to invest in, electric vehicles, but I think Elon Musk is crazy, stuff like that. And there is no ETF or mutual fund called EVs without Elon. So what we taught machines to do initially was not to explain what's going on inside a portfolio, but listen to an investor, latch onto those words, and build, basically research and create what effectively feels like your own personal ETF. So when you think of ETFs, you think of BlackRock, and the name of the company came from, a Pebble is just everyone's tiny own personal black.
Love it. I absolutely love it. So first of all, you sell yourself short. I think that's actually a genius name. You're like, oh, whenever we're good at marketing, I'm like, what are you kidding me? That's a slam.
We're great at puns. We're great at puns.
I think it's a great.
No, like every time you tell people about Pebble, they're like, oh, you're the watch? And I'm like, no, we're not.
Oh, I forgot about Pebble Watch. Does that still exist?
It's actually just got rebooted. We get a whole bunch of like internet traffic now because like
never. I completely forgot about it. I thought the Apple Watch just like put them up.
Pebble got bought by Fitbit. Fitbit got bought by Google, and I think like the original team that built the Pebble Watch, like Google released the technology or whatever, but they're rebooting the watch. So that's the origin story of Pebble. Just a pun.
Yeah, but
and then crystal ball. There are a couple things that are going through my mind. I do think the nature of wealth management is going to change. We've got this new demographic, and I attend a lot of wealth conferences and things like that. I get to meet with a lot of people, which is fantastic. But it kind of feels like everyone's talking about this new demographic that's coming in, but everyone kind of thinks the existing model of wealth is just it's going to largely be untouched, and people are just going to naturally flow right into it. And I was at this conference a couple of weeks back, the Tiburon conference, and Chip Rome, who was up there giving his keynote speech, actually hit upon a thing that has been deep in observation of Pebble. The role of retail brokers, I think, is like the battleground. I'll say it like this. The battleground for what wealth will look like 10 years from now is currently taking place at the retail brokerage level. And I don't think most firms are aware of that. You look at companies like Robinhood, who, again, 2021, everyone's becoming an investor. They're all jumping into, firms like Robinhood and Public and all that. So lots of account growth, completely the types of account growth that, is ignored by wealth management, right? Like you can't
too small of a balance. And all
I can't make enough money at 1% off of a $5,000 account to, even pick up the phone type of deal. But the reality is like those $5,000 accounts are going to be $50,000 accounts someday. They're going to be $500,000 accounts someday. They are going to be your client. They're just going to be your client a decade, from now. And I think what we're seeing is the relationship again, and this is the changing demographic of how people are learning about markets and their comfort with technology and the comfort of being able to find information on them, on their own, being able to distill the noise and all that type of stuff. I think brokerage will ultimately end up coming up with this Netflix-sized subscription model to create long tail wealth. So I think it is, if you think of how the existing wealth industry started at family office, ultra high net worth, and worked its way down. Yeah, brokerage is coming up from the other angle. And what's interesting is you look at some of these big wirehouses, like JP Morgan Chase has, private bank, but they've also got, retail, brokerage. Merrill Edge going into, Merrill's, wealth side. Everyone's kind of got that vertical funnel. You've got to be investing in creating micro wealth experiences down at the retail brokerage to attract these $5,000 accounts now to go ahead and feed into that funnel. Because I don't see is someone who has been, learned about investing on Reddit and TikTok and, got their first access and comfortable access with, investing themselves or trading themselves on Robinhood. I don't see that person just all of a sudden being like, I want to go, work with an RIA right now. It's just that just seems like like a disconnect. And so focusing on understanding that I think retail brokerage, is not just a cost center. I think it's actually a future, battleground, and we need to be coming up as an industry with this concept of micro wealth. And
love it. There's so many. We could have a whole episode on that because like Fidelity does this annual. I think they still do it. Like it's kind of basically annual report on American millionaire investors. One of the things it routinely says is the average millionaire hires their first advisor around the age of 40, slightly before 40. It's like, so if you've got this younger, exactly what you just said, right? Starting to invest younger, starting to be more active in their investing, and they're coming at it through these retail apps, and they're building and building and building. By the time they're ready for like, hey, I might want to have a professional working with me here, you might have missed a chance. So good stuff. All right. Very cool. It is pebble.finance is the website. Justin Whitehead on LinkedIn and probably other places. How can people follow along with what you're doing? Are you guys putting out a newsletter? You got some good stuff you're sharing with the world?
We'll see if we actually have this newsletter coming out. So, no. So we actually, early on, we ran, this is like while we had the SEC RIA spun up and we were working with direct investors. My co-founder was putting together his weekly newsletter. And back when we were at this company called Kensho, he also did this newsletter, and it was just, the Wall Street, the professionals in Wall Street absolutely loved it. But that's who we talked to. Like we can talk to advisors, we can talk to institutional asset managers. But we're thinking of rebooting that newsletter. Got a lot of traction early on in Pebble. He and his partner had 2 kids. Guess what? Life changes things. And you know what? Sunday, your entire weekend shouldn't be spent, putting in a newsletter, and all that. But we're actually thinking of bringing that back. But LinkedIn is probably the most common place that you'll see us out there and active.
All right. Sounds great. Well, thank you very much for coming on the show, sir. It's great.
Awesome. Nice meeting you. Take care.
Thank you very much for listening to and or watching this episode of the Modern Financial Advisor podcast. It's always fantastic to have you with us. Huge props to my man, Justin Whitehead, up there in the Boston suburbs, my old stomping grounds. Great to chat with somebody from the old country, as we like to say. Anyways, I hope you enjoyed the show as much as I did. Great stuff. As I mentioned at the top of the show, please do make sure you subscribe to the podcast on your favorite podcast platform and be nice to each other. We'll see you next time on the Financial Advisor Podcast. See ya.